Good morning. Thank you for joining us for our third webinar in our Money Workouts for Women. I'm Leanne Knight, the Director of Wealth Management here at North American Management. And while we have a few more people jumping on, I wanted to just mention a few housekeeping items. Everyone is automatically on mute. We're going to have a couple of ways for you to ask questions in the presentation. If you click the hand icon in your GoToWebinar panel, I can unmute you and when I stop for questions, and you can actually ask your question over the phone. But if you prefer to stay anonymous, you can type in your question using the questions pane, which is also in your GoToWebinar panel. Your question will only be seen by me, so you will be completely anonymous, but I hope you'll feel free to ask questions as we go along, and I'll stop periodically. And then, as always, I'll stay on towards the end of the webinar to make sure I answer any additional questions. Okay, let's get going. All right. So we know that this subject, which really involves insurance, is something most people don't want to spend a lot of time discussing. We tend to put the basics in place, pay our premiums, and we really never look at our coverage again as long as it stays in force. In fact, as you can see here, some of us are even in distinct denial about our own mortality. But because insurance is such a big topic, we could certainly spend more than the allotted hour covering all the various types. So today, so that I do stick to my hour allotment, we're going to talk about 3 of the 5 key types of insurance you should either have or know why you don't have it. I'll try to cover some of the common terms in each type and give a little explanation on how coverage works. I'll also try to give some guidance on when you need it and when you might not. But again, this is going to be covering a lot of basics today. And then if we have time, I'll also touch briefly on the many other types of insurance you might need to consider as well. So why do we avoid talking about insurance? There are a few common reasons, and there's a lot of psychology involved here. First of all, of course, we don't want to think about catastrophe. We don't want to really think about our house burning down or getting into a serious car accident. To talk about insurance, we really actually have to visualize what that catastrophe would be like so we can know how much we're really at risk of losing. And that's tough for a lot of people. We certainly don't want to think about our own death or even getting seriously ill. I think another reason people are reluctant to talk about insurance is that we often don't really understand the ins and outs of many types of insurance. So we don't want to look ignorant in talking with those people who know far more about it. And finally, let's face it, the only way to have insurance is to buy the insurance from someone who gets paid to sell it to us. So there's often some mistrust when discussing insurance with agents or brokers. And yet, really, we need to be thinking about insurance as simply a way to protect our hard-earned savings. It's simply offloading some or all of the risk of losing our money when bad things happen. So before we dive in, I'm actually going to pull up a quick poll for you to answer, because I love my polls. So let's see, I'm going to ask you, which of these types of insurance do you have? And you should be able to mark as many as you have. You'll notice that I didn't put in, I have to launch it, apologize. I did not put in the 2 most common, homeowners and auto insurance, because for the most part, both are either mandated by mortgage lenders and state insurance departments. So I know most people have those if they're a homeowner or a car owner. So I'll give you guys a couple minutes to vote here on the different types of insurance you might have. And we'll take a look at that. Okay, let's see what that looks like. So 100% of you have term life insurance. That's good to know that you are insured. And some of you have long-term disability, and some of you have umbrella insurance. And we're going to talk about both of those. We're also going to touch on what permanent life insurance is, and also when you might want to consider getting long-term care insurance. Okay, we'll continue here. Whoops, going too quickly here. So the 5 key types of insurance we have, or people should think about having, of course, health insurance, and that's a big topic in and of itself. That's beyond the scope of today's webinar, but I always want to point that out, the medical insurance. Life insurance, which we're going to talk about, long-term disability for those who are still working, property insurance, and long-term care. And of course, there are many others, and we'll touch on those, but really you can pretty much insure, for the most part, against any risk of loss, either to your person or to an object. So there are really 2 types of life insurance, and then we're going to start there. Most of you, as you answered in the poll, have term life, and I always talk about term versus permanent as the concept of renting versus owning. And so it's good to understand why and when you need each one. There are usually just really 2 different reasons to buy life insurance. One is for protection of your money in a catastrophe, and then the other could be for wealth creation or wealth preservation, and we'll go through both of those. So term is like renting. You pay your premiums, and when you stop paying, you no longer have coverage. It's pretty simple. It's the least expensive, and it's really there geared for income replacement. So if something happened to you today, how will your loved ones pay the bills without your income? For example, a 30-year-old probably has at least 30 years of income generation, and often that is a rising income over that time. And as that 30-year-old gets older, that income likely goes to paying off a mortgage, putting kids through college, even getting food on the table. So if you were to die prematurely, how do all those things get paid for? And I'm often asked, in fact, by non-working spouses if they need any life insurance. A non-working spouse actually could need coverage if you have young kids, because who would the caregiver be in their absence? So it's important to also think about, even if you're working, your spouse is not working, your spouse often needs some coverage to minimize disruption to the household. Term has the least expensive premiums. It often comes as either as short as a 10-year policy all the way up to 30-year policies. Nowadays, it's usually a level premium, meaning you're going to pay the same amount every year for the life of the policy. There's no cash buildup. It's like you're not really building any equity in that policy, but you can terminate it any time. Now, a variation of term is group term life through your employer, and premiums in those cases are often even paid by the employer. But here's something to think about. If you are relying on only group term or employer provided life insurance, it's often capped at a multiple of your salary, so say 1 or 2 times salary. And I know I often run into younger professionals who think they're covered for catastrophe because they're covered by an employer plan. Well, 1 to 2 times salary doesn't usually go very far, and that insurance will terminate when you leave that employer. So I usually recommend that it's prudent to supplement employer plans with some independent coverage that doesn't depend on your employment. Now, another question I get around term insurance is, once you're retired, do you still need it? And the answer is, of course, like most answers, it depends. You might not need it anymore if you are not trying to protect income that you earned or income from working. Um, and but there may be other types of income that you get in retirement, such as a pension, or even maybe anything else, perhaps some other stream of income, royalties, etc., that may end on your death. Pensions are the most common, where the pension may end on your death, and your spouse then is left without that piece of income. So in that case, you may want to continue your term insurance to cover that shortfall. So it's something you do want to look at when you retire. Now, permanent insurance works differently. It doesn't usually have a set term. There's one exception we'll talk about, and it can stay in place often even after you finish paying premiums. However, premiums are definitely more expensive than term, because part of those premiums go to the death benefit, but part goes to building up a cash value. Here's where you can compare it to earning equity in your home. Um, Permanent policies, and we'll go through the different types, are best used for building supplemental savings. Talk a little bit about that, or leaving money for heirs to pay estate taxes, or even simply as an inheritance. Um, there's nothing wrong with having a combination of term and perm, depending on your different needs. Um, so let's dive a little deeper and talk about the types of permanent insurance. And of course, you hear many different types and variations of this, but really, to keep it simple, there's whole life, universal life, and then there is a type of universal life that's very common. So we'll kind of try and go through some of these. So what's the difference between these types of permanent insurance? Well, whole life remains in force for your lifetime, providing you continue to pay the required premiums. As I said before, with all of these permanent policies, part of the premium goes to maintaining the death benefit, and part goes to building up cash value. Generally, with whole life, premiums stay the same, and the key difference here between other types of permanent is that the cash value accumulation is guaranteed. And there aren't too many guarantees in life, but whole life policies guarantee this because it really is like a forced savings account. That cash value builds up at a set interest rate, and you will know what that interest rate is every year. It's not invested, it's not subject to stock market risk. The insurer, in fact, is guaranteeing that you will get that interest rate on the cash as it builds up. One thing that people sometimes do with whole life policies over time with enough cash buildup is that if you decide to skip a premium or even to stop paying premiums because you have enough cash in the cash value, you can pay your premium from the cash value. Now, the key difference here with whole life is when you do that, you are actually borrowing from your cash value by establishing a loan to yourself, and therefore with accruing interest payable. So you can sort of project out, it is possible that you will be dipping into that cash value over time and building up essentially a loan payable that could eventually even reduce the death benefit depending on the circumstances. So you want to think through that pretty carefully if you do that with whole life. Universal life. There are actually three types of universal life: traditional, guaranteed, and variable. And its purpose, though, for all three of those is really, again, to provide coverage for your entire life. But universal life policies have three main ingredients, some of which are similar to whole life, some that are slightly different. First of all, the death benefit. You usually have a choice in universal life policies between getting a level death benefit, meaning you buy buy a policy for $1 million death benefit, the death benefit stays at $1 million. Or you do what I call a combination, where it allows you to specify the amount of the death benefit, $1 million, plus the cash value. So the death benefit, in fact, gets to increase over time by the amount that you've built up in the cash. And it's very important when you're looking at these policies to figure out what you have. Is your heir going to get that cash value in addition to the death benefit or not? The second ingredient is this cash accumulation that happens, where a portion of your premium goes towards building the cash in that policy. And by the way, in all these cases with insurance, this cash is growing tax deferred, so it's a tax favorable way of saving. It's in the case of a universal life, it's definitely building faster in the early years, because more of the premium that you're paying is going towards the cash buildup, less is going to pay for the death benefit or the insurance. That does tend to flip in later years, and again, could in fact the premium owed could actually be more than what you've been paying. When that happens, that's where the premium starts getting paid out of the built up cash value. The third piece of this, which is very different than the whole life, is that you have flexible premiums. You can kind of set the amount you want to pay for these premiums. You pay more, you have more of a cash buildup. You pay less, then the cash already there starts to fund more of your insurance. As the premiums are flexible, as long as the insurance piece continues to get paid. And we'll talk about what to do to make sure that stays in force over time. But you pay for this privilege. Universal life policies, typically the premiums are 3 to 4 times the cost of term. So it is more expensive. Now, the other big difference between whole life and universal life is that when you do withdraw or borrow against the cash value, you're not really borrowing. You're what you take out of your cash value is not considered a loan. You are just depleting that cash value. And so therefore, some people really do use this as a supplemental retirement income bucket, either to supplement their living expenses or to use it to pay premiums in a tax deferred or tax efficient way. So what's the difference between guaranteed versus variable life? Because you hear those terms a lot. Guaranteed universal life is also called, or often called, no lapse universal life, and because you can structure the premiums to provide coverage until a certain age or a certain number of years well beyond your lifespan. So you could say up to age 95 or up to age 120, so that you effectively have lifetime coverage. Usually the premium is a level premium and a level death benefit. So over time, if the cash value is being used to pay part of that premium, you may not have as much cash value buildup as you would in a variable, and we'll talk about why that is. This type is not always ideal for supplemental income because it may not create enough growth in the cash to provide that. Variable universal life, on the other hand, and again, this is a very popular tool to use for people who do want to have supplemental income from a life insurance policy, uses sub-accounts, which are essentially mutual funds, to invest the cash value. So as your cash value builds up, you can choose different funds. You can be very aggressive, you can be very conservative. It will, of course, depend on your broader picture to have potential growth in that cash value. Of course, it is subject to market risk, so it can go down. What are some of the negatives for using permanent insurance? Certainly, we talked about how much more expensive the premiums are. The premiums can go up as you get older. Depending on the type, you may have a repayment or loan interest on borrowed cash value. And certainly if you're using a variable universal life, you're going to want to monitor the cash values and treat it as any other investment or piece of your portfolio. I do want to mention one other type of policy that you might have or you may want to have, that could be a whole life or a universal life policy, and that is second to die. This doesn't pay a death benefit until the second death. So many couples will put this in place to be able to provide their heirs with money to pay estate taxes, and or even inheritance, general inheritance, because it's really timed to pay out on the second death when any estate taxes would be due. So you will see that option as well. Okay, so that was a very quick run through of the basic types of life insurance. But really, what do you need to consider about these different types of policies and how much to get and when to get it? These are some of the questions you want to be asking to determine the amounts and the appropriateness, because there are many more nuances and bells and whistles to these policies. Term generally is good for young families before they have built up a lot of savings. It's really catastrophe geared. It's for income replacement. You may not need it once you're retired, so it's always good to look at any term policies at that point in your life. Use it to pay off the mortgage, use it to pay for college. And also just remember to look at how much you're being offered through an employer. Permanent can be good if you want a supplemental tax deferred savings account. Maybe you're maxing out all your other ways to save in a tax deferred or tax-free manner. It builds up cash value that can be withdrawn tax-free or through a tax-free loan from the policy. It can certainly be seen as a diversifier in portfolios. And it's absolutely a good way to provide money for heirs to pay estate tax. By the way, heirs do receive the death benefit tax-free. So again, a very tax-efficient way to pass down money. And if your policy is put into an irrevocable life insurance trust, it gets that death benefit is out of your estate. So again, another plus for estate planning. So, and I often do get asked, I will tell you, if you're single, should I have life insurance? And that is a good question. I think you have to look at if you either want to leave money to other people or if you have certain obligations that would not be discharged in death, and you want to make sure that someone else is not going to have to pay for those. But otherwise, single people often really don't, especially if they don't have children, may not need a lot, if any, life insurance. You should review these policies periodically. This is the biggest admonishment, I guess I will say, is that we often put these policies in place, especially if we have 25 or 30-year policies, term policies, and what would have been adequate coverage 20 years ago may not be adequate coverage today, given your increase in income, your increase in your family, increase in a mortgage. So make sure you are reviewing the coverage periodically. You should always do it when you have a life change, getting married, getting divorced, having children, or an income change, significant income change at retirement is a good example, or a tax law change. We recently had the annual lifetime federal estate tax exemption doubled here in the last year. So it may be that some of these policies aren't as critical to your overall estate plan as they would have been a year ago. I will tell you there are calculators available that can do a discounted cash flow modeling on income to really kind of determine how much coverage you need to replace your income into the future. Or to calculate potential estate taxes when you die. And using these calculators are often the best way to really understand the risk for your particular situation. If you do have permanent insurance, you do periodically want to ask your agent or broker for a current illustration to make sure it's going to remain in force even at current interest rates, current market conditions. So that is, very critical. Okay, I am going to stop here and for a minute to see if we have some questions. And I'm going to ask Kelsey if there are any questions that I can answer about life insurance.
Yes, there is one. What happens to the cash value when I die?
That is a great question, and one I hear a lot and can be a little confusing. Unless your policy specifically designates the death benefit to be the original death benefit amount plus the cash value defaults back to the insurance company. So that is something to think about when you are building up a fair amount of cash value in a policy, whether or not you want to be using that as supplemental income while you're alive, or if in fact it will go to your heirs or not. Good question. Okay, I'm going to keep going, and we will obviously take any additional questions at the end. I just want to make sure we cover everything today. Okay, I'm going to, oops, there we go. I'm going to, apologize. Disability insurance. I want to talk a little bit about this because even though I noticed on the poll that some people do have this, it's often something we sort of know we need, but fewer people than should have it, and it's very important, I think, when you're working. According to the Council on Disability Awareness, 1 in 4 of today's 20-year-olds will be out of work for a year or more due to disability before they retire. That's a pretty high percentage. Most people think disability insurance kicks in when there's a debilitating injury, but actually the 2 most frequent causes of long-term disability are chronic back, hip, and knee issues, and cancer. So not necessarily injury during your working years. And again, this concept of disability insurance is to provide income replacement if you're disabled while you're earning income. So if you think about that, 1 in 4 are likely to be disabled versus think about the percentage of people who actually die before age 65 while they're still working. And yet many more of us have life insurance than we do disability insurance. So this is not, long-term disability is not to be confused with short-term disability, which is often offered by employers as well. Short-term disability is just that. It's if you're needing to be out of work for, usually up to 3 months is the short-term time frame. And this could be just simply surgery recovery, or maternity leave is a frequent one. Long-term disability is really for those situations that are potentially permanent and also offered through employers, but usually at a incremental cost. So here's some common features to consider when you're evaluating your disability insurance. The first one is, when does it consider you disabled? Policies will pay in one of 2 ways, or for one of two reasons. They will either pay if you can't do your own occupation, or they will be structured to pay if you can't do any occupation. Clearly, you should try to find a policy that pays if you cannot do your own occupation. This is especially important for those with non-physical jobs. I had a friend a few years ago that was felled by a major heart attack in his 40s. He was a partner in a law firm, and after that, he was in the hospital for many months. He could no longer really put in the grueling hours required to continue to do that particular job. He probably could have, however, done some other type of legal work or part-time work, et cetera, as his mind was still sharp. But if he had not had own occupation disability insurance or coverage, he might not have qualified for long-term disability, which would have been fairly devastating for his family, as he was the primary breadwinner. So look at that. The second question you always want to ask about disability insurance is, how long is the waiting period or elimination period? When does this actually kick in? In most cases, 90 days or 180 days is most common. And that's partly, I think, due to the fact that many people also have short-term disability that covers those first 90 or 180 days. How long will the benefits last? To age 65 is the most common, but that's actually a little bit outdated now, because I think that was designed many years ago when Social Security would kick in at age 65 in the past. But of course now, for people coming up through the workforce, the Social Security will not, full retirement age for Social Security is not till age 67. So there could be a little bit of a gap there. Some policies will specify a certain number of years, not an age, but again, it's best that it matches up to when you think you can retire and go on to Social Security or some other form of income. Another fallacy around disability insurance is that it replaces your income. It really very rarely replaces 100% of your earnings. It more often, most likely, will replace 60 to 66% of your current income, and many policies even are capped at a dollar amount. So make sure you understand how much of your income will be covered, because you may need to change the policy if you can. This is even more important if you're self-employed. I think it's very critical to get. It's not inexpensive, but with employers providing and subsidizing premiums, it's pretty inexpensive when you are getting it through an employer plan. It's still very important if you're self-employed, and others, especially, or you are depending on your income. This, I would say, is more important than life insurance for a single person. So keep that in mind. Okay, I'm going to move from life and disability to home and auto insurance. Again, two things that a lot of people have but may not have thought a whole lot about. And how do you evaluate what you have? Well, let's talk about homeowners insurance first. And again, this is periodically you should be looking at this, especially if you don't have a agent or broker who is really inquiring about these things with you. You want to look at how your coverage is defined. You can have coverage for your house that either is at replacement cost or cash value, and those are really two different things, especially for your contents in your house. For instance, you might have a perfectly functioning 10-year-old flat screen, I guess there could be 10 years old, flat screen TV that you watch every day. Love it. Will miss it terribly if something were to happen to it in a fire. If you can cover your contents with replacement costs, you're going to end up with the latest and greatest brand new television. However, if you only have your contents covered at cash value, the insurance company is going to take into account depreciation on that television, and it might in fact be worth nothing. So that's going to make have a very different outcome if you need it to file a claim. Another thing to remember on the value of your house is that replacement value, it actually could be higher than the current market value of your house. So make sure you know the exact wording in your policy. Certainly with construction costs, et cetera, what you could sell your house for might actually be less than what you would have to build a new house for in the same place. You also want to make sure other structures or features are covered. If you have a separate garage or any sort of separate structure on your property, if you have a swimming pool, you want to make sure that is also covered under the policy. If you have any luxury items, so jewelry, art, antiques, any of these things may need separate riders if you want full replacement value for them. There's usually a fairly low dollar limit within the main policy, so you want to designate those separately. Another major item to review on your policy are your deductibles. The higher the deductible, the lower the premium. And really, especially as you go along, you may not mind paying the first $500 or $1,000 of a loss yourself, uh, or a potential loss, in order to pay lower premiums for the policy. So make sure you're comfortable with that. Um, Another thing to think about with homeowners insurance is that many insurers today offer discounts, affinity discounts, and other types of discounts, and you want to make sure you're getting all of the ones that apply to you. For instance, if you're a AAA member or a member of AARP, there are discounts. Many carriers will offer discounts for safety features in your home, alarms, even good grades for younger drivers, or going claim-free for an extended period of time. And almost all of them that I'm aware of do offer a discount if you insure both your car and home with the same carrier. So make sure you're taking advantage of all of those. Now, the question I often get is, how do you tell if you're over or under insured? And I would say, again, there are five primary things you want to look at. One is that replacement versus cash value versus market value. Make sure you have that in the right place for you. You want to look at your liability coverage limits. If someone falls on your property, and we're going to talk a little bit about how to supplement some of this with umbrella insurance in a minute, but you really want to understand what kind of liability coverage you have. Something happens within your home to someone else. Understand the endorsements. For instance, sometimes when things happen in a house, let's say the power goes out for several days, if you have an endorsement that covers your refrigerated property, you will be able to replace all of that food. But maybe you have that refrigerated property coverage and you eat out all the time and there's nothing in the fridge. So look and see what you're paying for some of those things. Is it something that you really are going to risk a loss in? Look and see what the exclusions are. Again, you may need separate riders for very expensive items. A very common exclusion, in fact, is backed up sewer uh, problems. Most people think, when they think about some of the disasters that can happen, obviously we think about fire, but there's also mold, roof leaks, termites, busted water pipes. All of those things typically will be covered in a homeowner's policy, but the backed up water pipes will, but the busted water pipes, but the backed up sewer damage might not be. So you might have to put in an extra rider for that. People often ask or get confused about what happens in natural disasters, and what's covered, what's not covered. Certainly in a lot of cases in more recent years, we've heard a lot about flooding in different parts of the country, and flood insurance is typically not included as part of a typical homeowner's policy, but it can be provided by the National Flood Insurance Program under FEMA. And depending on where you live, that may even be required if you have a mortgage. The other one that probably more people should have than do is earthquake coverage. We tend to think of California, where in fact earthquake coverage is typical and is actually probably a little more expensive because the likelihood is greater there. But for example, where I grew up in Oklahoma, we never had earthquakes growing up, but since 2009, there have been at least two 5.6, 5.8 quakes there that caused some significant damage, and certainly thousands of lesser ones now. So, more and more people in Oklahoma, for instance, should probably be looking at earthquake coverage. Another example to think about is living next to high wildfire areas. This can make it difficult sometimes to even get homeowners insurance or increase your existing insurance, but know what those risks are as well. So on auto insurance, some of these same concepts apply. Really understand what exactly is covered and what the liability limits are, what your deductibles are, and what is not covered. Each individual state sets many of these liability and property damage minimum requirements, but you probably want more than the minimum, so make sure you understand what those are. In fact, most insurance agents will recommend liability coverage of $100,000 per person and $300,000 per accident. But the minimums could be less than that, so make sure you are adequately covered. And again, we're going to talk about how umbrella insurance helps with that too. Property damage coverage should be looked at as well, because it really should be mirroring what you usually pay for a new car. It could be put in there, the minimums could be significantly less than what you would be paying to get a new car if your car was totaled. And then something people don't always think about when determining coverage amounts is where do you drive and how frequently? If you live in the suburbs, you park your car in your garage and you only drive around town, you probably are going to need less than if you live in the city, park on the street, drive an hour each way to a job, etc. So really evaluate where you live. That can make a difference. Also make sure you have uninsured motorist coverage. Now, I know some states require this, not all states, so that is a very important thing to make sure you also have uninsured motorist coverage. If you take out a car loan for this auto, you'll likely be required to have comprehensive coverage. This really covers if the car's stolen, burns up in a fire, etc. You may want to even consider that if you don't have a loan on the car, because it's not just about getting in an accident. Other things can happen. So what are some things to think about that you might not need in a policy? There are a few. I would say look at your coverage or what you're paying for your coverage for medical payments. This is really designed to pay deductibles before health insurance kicks in an accident, so it may be that you can waive that. Towing and labor is often part of a policy, which you might not need. If you already have AAA, you're not going to need to pay extra for towing. Rental insurance. This is a common one that people sometimes think they have and don't have, or might not need. But really, do you have another car you can use if something happened to your car and you had to use another car for a few days? So it's important to know your situation on that. Glass breakage. This can sometimes add as much as 20% to your premium, and maybe you're willing to kind of self-insure for that and pay that separately. Two additional things I'd remind you is, remember, frequent claims, even if they're very small, fender benders are a red flag to insurance companies. And more they are not renewing policies for people who have several claims, regardless of size. So you only want to file claims you really can't afford to pay yourself. And then finally, with teens, and this is something very near and dear to my heart, they do tend to get into fender benders. So you want to make sure you keep up with which car they're driving and how often. If they're only driving your car periodically or only driving a car periodically, you can name them as an occasional driver, so that your rate is not quite as high. Of course, if they're driving every day to school, you're going to want to have them be a primary driver, hopefully on your least expensive car. And then remember to change their status, of course, when they go off to college and may not have any car with them. Okay, I'm going to talk about umbrella insurance here for a minute because this is really something very important. And I noticed in the poll, some people have it. This is really kind of the third leg of the stool when you have a homeowners and auto insurance. We talked briefly about looking at your limits on homeowners liability and the auto liability for accidents that involve other people. If you hurt someone in a major auto accident or someone has a major accident on your properties, especially if you have a swimming pool, there's always risk there. All of your assets are vulnerable. And that means that if you really have a major accident, the cost either of life or the cost of injury to someone else can quickly result in a lawsuit and costs that are above your limits in your homeowners and your auto. And this is where umbrella insurance kicks in. It sits on top of those policies so that when they get maxed out for a major event, the umbrella insurance coverage kicks in after you've used those. Now, this type of insurance is quite inexpensive because really insurance companies know not a lot of people ever have to use them. And it usually starts at about $1 million in coverage and goes up from there. So figuring out how much umbrella you need, you really want to look at your net worth. Make sure you have a combination of auto, property, and umbrella insurance to protect it, because all of that is vulnerable. And this is even more important to put in place when others are working for you, say nannies, au pairs, household help, because if they were to cause an accident, that is on your policy. So make sure you get that in place if your net worth is $1 million or more. Personal property, we talked a little bit about this earlier. You want to make sure you have riders for any significant jewelry, art, antiques, a rare coin collection, watercraft, etc. Another type of insurance I always like to mention is renter's insurance, because not everybody owns their own home and doesn't think about the fact that things happen in buildings and in apartments that are rented. And this is very important for students and young adults who typically are renting. You want to make sure you've got adequate renter's insurance to cover your contents of your apartment or home that you're renting. And again, like everything else, my mantra is evaluate all of your coverages periodically. Clearly, the value of your homes and your property increase over time. Make sure your insurance is keeping up with those increases. All right, Kelsey, I'm going to stop here for a minute and see if there are any questions on property insurance.
Yes. Can you give us some more examples of homeowners insurance endorsements?
Yes, I think we talked about some of these. These are really things like I mentioned, the refrigerator policy, refrigerator contents, but you can have endorsements that do cover earthquake, as I mentioned before, the sewer backup. A very frequent one, and one that may be overlooked a lot, is computer equipment. Your existing policy may not really cover the full replacement value of all of your computer equipment, so you'll want to make sure you have that. Small watercraft, generally bigger watercraft need their own policy, just like a car does, but a small boat, sailboat, depending on size and value, could probably be put on as an endorsement on an existing homeowner's policy. And then if you have any home-based business, you want to make sure that is addressed separately within your homeowner's policy, and that because that could cancel your whole policy if something happened related to your business that you run out of a home. So good question. Okay.
It looks like we have one more question.
Okay, yeah.
Let's see. What happens when the replacement value of a home is greater than its market value? Does it make sense to pay those higher premiums on replacement?
Uh, I would say yes, unless, I mean, you need to picture what that loss looks like for you. If you are going to want to rebuild the same house in the same location, um, you really probably want replacement value. If you don't know that you would do that, say you might build a smaller house, you might move, etc., um, then it may not be as critical. But replacement value is a fairly common. It's usually replacement value or cash value on the contents. But I would make sure, rather than a specific dollar amount, that you have replacement value in most policies, unless you wouldn't rebuild. Yeah. Okay.
Uh,
Oh, another one?
and yes, one more. And
Okay.
what about pets? Do you have to have an endorsement for a dog or a cat?
That's a really good question. I'm not sure I even know the answer to that. I know I do not on mine. I suppose there might be certain situations where you either might want to put on a specific endorsement. I do recall, I have a very proactive agent personally, and she does ask us that question. So it, in fact, could be built into the overall calculation of the premium, that we have. Dogs usually are the ones that people tend to worry about. Good question, though. I will try and determine how common that is as an endorsement, and get back to people on that. Okay. Is that it, Kelsey?
All right. It looks like we have one more.
Oh, okay.
If your property value is going up, oh, you know what? We have one more. If your property value is going up, do I need to review my insurance if the premium keeps going up due to the increased dwelling value?
I would say yes. You still want to review your policy once a year. I mean, most homeowners policies are renewed each year, and if your premium is going up, it is probably capturing that increased value, but that should also be reflected either as a coverage amount on your uh, updated annual statement, declaration page, or if it's at replacement value, then that would probably be fine, because they're recognizing that in an increase in premium. Um, it also may make sense periodically to shop around and see, maybe a certain company is raising premiums more quickly than other insurance companies. So I certainly wouldn't discontinue a policy until you have a new one in place, but to periodically look and see what other rates are makes a lot of sense. You don't have to do that every year, but I would do it periodically. Okay, I'm going to keep going, Kelsey. If you get any more questions, we will address them at the end. Okay, long-term care, and I will probably go through this fairly quickly, but I do want to do a quick poll. Kelsey, if we could do poll number 2. So this poll is, what percentage of Americans will need some form of long-term care during their lives? Give it a couple more minutes, a couple more seconds. Still voting. Okay, I think we can close the poll. Okay, so 14% of you said 25% of Americans, 14% of you said 92% of Americans, and then most of you said 70%, which is absolutely correct. 70% of Americans, this is from the Institute on Aging, over age 65, will need some form of long-term care during their lives. That's a pretty high percentage. And as you can see here, there are a lot of reasons in particular why women will be using long-term care. I do want to touch briefly, hopefully, on how long-term care insurance works, because it does work a little bit differently than other types of insurance. It's really designed to slow down the spending of your own assets for care. It will partially offset the cost of the care. It does not usually take care of the total cost, and I think that's important to remember. It's really just to slow down the spending of your own assets. Okay, so care cost is usually quoted on a daily amount or a monthly amount. Do you want to cover $200 a day of care, $350 a day of care? For instance, if you are getting care at home, some of you may decide you want to age in place at home. If you can, you might only need, in today's dollars, $150 a day. But if you are convinced that you want to be in assisted living or may need to be in a nursing home, I mean, that care can be as high as $400, $500 a day. Once you think about that, the second decision is around how many years of care do you want to cover. The most frequent time periods chosen are 3 to 5 years. I think the average stay in a nursing home is about 2.5 years. So that's why people tend to choose that time frame. That said, Alzheimer's patients can easily require 10 years or more of care. Now, you may not want to insure for 10 years, but it's important that you know that is a risk. The third decision you'll need to make is if you want that daily coverage amount to increase with inflation. If you're buying this policy in your 50s or 60s, you might not need it for 20 or 30 years, so inflation is probably a certainty. But if you're buying the policy later in life, even in your 70s, you're going to be paying higher premiums anyway because of your age, and so the inflation rider might not really be worth it. But once you have these three amounts determined, your amount of coverage is calculated, and it is really simply giving you a bucket of money. It's a simple mathematical formula which takes the daily limit times 365 days times the number of years of coverage, and that's your available bucket. So, for example, if you wanted coverage at $300 a day for 4 years, you would have $438,000 available to use on long-term care. And the way that works is you wouldn't be able to use more than 300 a day, but if you use less, your bucket might stretch out for more than 4 years. So you're not limited to those 4 years. A few other things to remember: the cost of these policies are cheaper the younger you are, but I typically don't recommend starting them until you're 50 or older, as you're going to be paying premiums for a long time. So I often get asked, how do you evaluate if you even need the long-term care insurance or not? And there are a few things to think about there. A general rule of thumb is that if your assets are less than $1 million and you need care, you may be better off putting the cost of that premium towards building your savings for the future. $1 million goes pretty fast in a care setting. And once your assets are depleted, Medicaid kicks in. And I don't really have time to explain how Medicaid works, but you will be covered under Medicaid at that point. If your assets are large enough to fund several years of care, say 10 million or more, you might choose to forego paying for the insurance. So you're effectively self-insuring. But if you want to make sure you're leaving most of your money to your kids, that may be another reason to go ahead and get some long-term care insurance. Regardless of your assets, you may want to consider some amount of coverage if you're single or if you're a woman. Women live longer than men and often end up without a caregiver at the end of life. So that may be a reason, regardless of your asset size, why you want that. If you do not want to burden your children with paying for or providing your care, having at least some long-term care insurance allows them some flexibility to make sure you're getting adequate care or staying in your home longer than you would otherwise. And finally, on that, I just want to say, if you're working and your employer offers a group long-term care insurance plan, consider getting it even if you're younger than 50. The premiums are usually very inexpensive, and the policy is portable. That's very important to remember because the life insurance policies are not. If you leave the employer, you're done with your insurance, life insurance. But with long-term care, those policies are portable, meaning they're yours. You can take them with you. You may have to start paying the premiums on them. But if your employer is no longer subsidizing. And the fact is, even if you're younger, you're at your healthiest, so the premiums will be pretty low. Unlike life insurance, it's also important to remember long-term care insurers don't have to insure you at all if they're concerned about chronic conditions. So it's important to get this in place before you start having health issues. Okay. Here's just a few more statistics on long-term care. I'll mention two quick things to be aware of. If you're married, there are options for shared policies. If both you and your spouse qualify for long-term care insurance, you can save some money on premiums by getting a shared policy. This essentially doubles your bucket, and what's not used by one of you can be used by the other. So that's sometimes very beneficial. The other thing that I'm seeing more and more of these days is what are called hybrid policies. These are newer, they come in a lot of different variations, but essentially these are policies that combine long-term care insurance with life insurance, essentially providing a residual death benefit if the entire long-term care benefit isn't used. And this really addresses one of the biggest complaints about long-term care insurance. If you didn't use it, you lost, your heirs never got it back. But in these hybrid policies, there is a death benefit that then gets paid out to the heirs. These are structured in a few different ways. Sometimes it's a single large premium and it's put in place, or it can be shorter time frames for the premium payments. You just want to make sure you understand those different components and that it fits your situation and how it would work in different care scenarios. Okay, that was a very quick tutorial on long-term care insurance. There's a lot more to that. Make sure you do understand how it works and when you can start claiming. Other coverages to consider. Obviously, if you own a business, you've got a lot of other types of insurance you want to consider. Key man insurance, cybersecurity, errors and omission. Again, just make sure you've got somebody helping you with that. Travel insurance, I'm seeing this more and more, and I think in this current environment, and especially if you're traveling globally, you probably do. And as you get older, things do happen from a health perspective. You may want to purchase travel insurance when you're taking significant trips. There are also medical evacuation policies, short term for specific trips that you might want to consider. I always get asked about pet insurance, so I threw that in here as well. In the past, I might have said that it was probably a little unnecessary to buy pet insurance, but as pets become more and more another extension of our family, and the medical procedures that can be done on pets continue to increase, this may very well be something you want to consider if you spend a fair amount on your pets. The last two I wanted to mention, wedding insurance, or really any kind of major event insurance, should probably be purchased, especially if there's one that is contingent on the weather. One that I have not purchased, not sure I will, but if you travel a lot, you can purchase bed bug insurance in case that happens to you. And then finally, you could insure any specific part of your body. For instance, Bruce Springsteen insures his voice. I suspect some professional sports figures insure their arm or other parts of their body. So that's another option. Remember, if there's a risk of loss with something of value, whether it's an object or income, it is likely insurable. Okay. obviously, I'm saying you should review this annually. You don't necessarily need to make big changes annually, but just making sure your coverage is still adequate. Did your house value appreciate? Did your income change? Did you retire? Has your net worth increased? One thing you always want to make sure you check periodically is who are your beneficiaries on your life insurance policies. Anything with a death benefit, you want to make sure you've got the right beneficiaries on there. And in fact, remember, Social Security itself is a form of insurance. So make sure you check your Social Security earnings record as well. The main thing, of course, was something you don't want to think about and look at is just to get started. And if you're not sure where to start, I would say ask your agent or your financial advisor for a policy review. We here at NAM, we don't sell insurance, but we often do these reviews for clients as part of their overall financial plan. And it's a good idea to do that periodically. And of course, as I always do, I wanted to give you a couple of resources for additional insurance knowledge. The first one is if an elephant sits on you, are you covered? This is really how to talk to your insurance agent about being properly insured, questions to ask. The second one is very much of a primer on insurance concepts and definitions. It's a great book for basic information. All right, we flew through that. I appreciate you guys staying on here. There are a couple of things here are upcoming, the remaining money workouts. The next one's July 25th. Many women, as you know, go in and out of the workforce as they have children, which creates a unique set of concerns. And our July webinar is going to be focused on how to financially manage what I call a non-linear career, what to consider before you step off the treadmill, as well as how to get back on smoothly. So I hope you can join us for that, and certainly feel free to invite any other young women that or older women that are contemplating leaving or going back into the workforce. And I'm going to take a few questions here at the end if you have them. Here's my contact information. Certainly, if you have questions you don't want to ask or don't think of until later, feel free to email me. Be happy to try and address them. And I'll leave up our final slide on our general disclosures while I answer any further questions, Kelsey.
What's the difference between an insurance agent and a broker?
Yes, sometimes those are used interchangeably. In a nutshell, an insurance agent is really working for or on behalf of the insurance companies or carriers. So an insurance agent can either be working for one insurance company only, selling their product, or could be an independent agent. Actually, if they're only working for one, they're usually known as a captive agent. If they're working for multiple insurance agents, insurance carriers, they're known as an independent agent, but they are working for the carriers. A broker is really working for you as the insurance buyer, and they are out there trying to find the right thing for you. In both cases, insurance agents or insurance broker have to have passed their insurance exams, be licensed with the state. Agents and maybe even brokers have to be able to do business with specific insurance carriers. So all of that has to be in place before they can help you, but that is the main difference. Agent works for the carrier, broker works for you. Okay, what else?
That looks like gets it.
Okay, great. Well, again, I appreciate everyone for joining us, and I look forward to seeing you on our next webinar, July 25th, Managing a Nonlinear Career. Thank you.